Let's go to the next please. Okay, so 5 critical reasons for home ownership. One is it's a hedge against rising rent. So let's say that we have combined income of $135,000 a year, could be less or more. The amount of the income is not what's important. It's just the idea that whatever that income is that you start when you begin the process of working, you basically have 30 or 35 years. This graph shows that you have 35 years, and you'll notice that the rent, if you rent, it goes, well, their income, this income, $135,000, is based on rising income, and they're making about 3% more a year. So at the end of 30 years, they're going to be making around $220,000 by the time they retire. Okay, everybody with me on that? That's the basic premise. Then you go down to the bottom here, and you'll see that there is the 4552, which is the blue line, and the blue line is owning a home, and the yellow line is renting. So you'll see right away that for about a $675,000 purchase, the total payment is about $4,500 a month. The rent is about $3,200 a month. Now that's in our area. It could be a lot less in other areas. So just kind of learn from the principle here as we go through. You'll see that in about year 9, there is an inflection point. And at that inflection point, you'll see that all of a sudden the rent payments begin to pass the housing payment. And this is really important. This is a really big deal that a lot of people, especially millennials, don't quite grasp until we really help them with that. Because normally they're not really taught about this, and they're not really exposed to it. But the idea is that as this rent inflection point occurs, all of a sudden your rent becomes more money. And as your rent increases, it takes away from, if you can see my pointer here, it takes away from the income that you're receiving or the raises that you're getting. So every time you get a rent increase, it takes away from that income or any kind of discretionary income that you're getting from the fact that you're making more money. And then you'll notice that with a purchase and with a home purchase, the payment stays the same. Now that 4552 actually drops by $200 or $300 because the mortgage insurance drops off. And we'll explain a little bit more about that. Okay, so at the end of 30 years, what happens is that you have, all of a sudden, you have a rent payment that's $9,980, and you have a payment which is $4,552. Now, when we talk about shared home ownership, we're going to cut that in 3s, right? We're going to divide that by 3. So right now, I'm just giving you a very generic idea of what it looks like, just as if somebody was buying their own home. Okay, any questions about that as we go on? Before we go on? Okay. All right, number 2, it's a hedge against rising home prices and interest rates. And so what you have here is you have 2 brothers, and you have brother A and brother B, and they have the same credit, they make the same income, everything is the same for them. And you have brother A and they get a $25,000 gift. And they each have,
in 2 weeks.
what's that? Someone asked a question? Okay. All right. So so brother A says, I'm going to go ahead and buy a house now. And brother B, which is our individual over here, he says, no, I don't want to buy a home because I don't want to pay mortgage insurance. I'm sure you've heard that if you put down less than 20%, you have to pay for mortgage insurance. And mortgage insurance is a insurance policy that you take out when you buy your home that insures against default on the property. So if you were to default on the property, the lender gets money as if it was a 20% down payment. So it really doesn't give you anything in particular, except that it allows you to make it so that you put down a lot less money. And that's a really important deal. Okay, now, so what happens is that brother A says, okay, I'm going to buy now with the $23,000. That's he has 25,000, his outlay is 23,625. And then you have 5 years where brother B says, I'm going to buy in 5 years after I save up the money, which is going to be $164,000. Well, after 5 years, who comes out better? You'll see at the bottom of the screen, the couple or the individual that buys today has more cash in their pocket after 5 years, which is $88,000. Now, that's not the only thing. What happens also is they go on to the next one, and that's your equity and investment. So now what happens is that brother A, his home is now worth $821,000 because we figured that it went up on a conservative basis, 4% a year. Now, what's interesting about that is just last year, home prices went up 19%. So there is a very, obviously prices will go up. This is a conservative estimate. The balance on brother A's mortgage is $592,000. The total equity that he now has, is $228,593. Well, brother B hasn't bought yet. He's in the process of buying. He doesn't have any equity because he hasn't bought his home yet. And so by brother B waiting to buy, the opportunity cost, in other words, the cost of waiting to buy brother B was $316,681. That's a lot of money in a relatively short period of time for deciding not to buy when both brothers had the capability to buy. So there's a really big deal about the idea that it makes sense to buy when you can buy responsibly as soon as you can. Now, again, we're talking about shared home ownership. So all of this is going to be divided by 3 as an example that I will give you. But I just want to give you a taste of the compelling reasons why home ownership is such a big deal. Of course, the third one is equity, wealth, and accumulations. People who own homes tend to save more money, and their median net wealth is higher as a result of saving money and equity accumulation. And then, of course, what's important here is that there was a study done, and this study was really important. It showed, it was from 1997, actually 1999 to 2009, by a Harvard Joint Center for Housing Studies. And they found that at the time that an individual was going to buy their first home, their net income was $8,000, or their net worth. Median net worth was $8,100. A renter's median net worth was $1,500. So the question that I want to ask to Miracle and Maria is, why do you think that the difference between somebody renting and somebody who has the intention to buy, why is the person that has the intention to buy where their net worth is so much higher? Now, understand that the people wanting to buy at $8,100, they haven't bought yet, but their intention is to buy. So my question to you is, why do you think there is such a big difference between the two? Got any thoughts on that at all?
Sorry, John, the question is why the median net worth is higher on owners?
On why the median net worth for somebody who is ready to buy is so much higher than somebody who is just renting and has no desire to buy.
Well, because they are saving, right? That's probably one of the reasons. When you are saving for your down payment, you are very careful with your expenses and.
Right. Okay, that's one reason. Okay, good. That's exactly right. Very good. So a study that was done, this study in the Harvard Joint Center for Housing Studies gives us the reason. And here's the reason. Let me read it to you, give you kind of an idea of what this is. They said, even before realizing any returns on the investment in the home itself, in other words, they haven't bought a home yet, the drive to become an owner, which is what I call the drive to buy, results in substantially higher wealth than those who remain renters. Okay, let's get it goes on here. In the year leading up to buying a home, household wealth increases by an average of 33%, then more than doubles in the first year of owning. Why? Factors that contribute to this jump in wealth include getting married, working more hours, and a slightly higher incidence of inheritance and gifts. And that's where I said the drive to buy becomes so strong that it doesn't matter if people tell you you can't afford it. Wealth continues to increase after the first year by 17% on average annually. So we go back to this example and you can see what happens is that here they start out with 8,100 median net worth, and at the end of 10 years, and this was during the subprime crisis, their net worth was $94,400, whereas those who were renting with no desire to buy had a net wealth of $1,500, and it ended up being $1,100, so they lost $400. It's a really powerful explanation as to why it is so important to think about the idea of owning your home. Now, this next one here, I'll go through very quickly. This is why I'm waiting. I'm waiting for prices to go home. So people talk about trying to time the market. And when we try to time the market, we'll give you an example. The purchase price on this home is $750,000. Loan amount is $600,000. Rate is 4.375. And somebody comes out and says, I'm going to wait to buy a home because I think their prices will go down. So let's pretend that prices do go down. Let's say they go down from 750 to 700. But the problem is that many times the rate will increase. And if the rate increases, you end up paying more interest and your payments are higher over an extended period of time. And so the difference between the two options is that if you wait for the prices to go down, and in that time, if rates rise, you're going to end up paying $90,000 more in interest over the life of the loan. So when people try to time the market, it's not always a good idea. Really what happens is that when you find a home that you like and you can responsibly buy it, you want to definitely go ahead and think about really seriously consider buying the home. Okay, and then of course the number 4 is appreciation. We've talked about that. Prices of homes rise. Sometimes they dip. Sometimes they go down a lot. That's what happened during the subprime crisis. But generally speaking, prices of homes always rise over a period of time. And historically, over the last 30 years, they've gone up 4% per year. Okay. And then in that example, it was an average increase of 11% over the last 5 years. Then we have quality of life. And we've already talked about that. Graduation rates are higher. Children's health is better. Net family wealth is higher. As a result of owning, there is a decrease in children's behavioral problems, reliance on government assistance, lower incidence of asthma for children, and lower incidence of divorce rates for couples. So it's a really big deal when we talk about the critical reasons why it's so important to think about owning a home.